Hi, and welcome back to Tim Bingham's Options and Volatility Newsletter. We're going to be taking a look today at a different way to play NVDA as we take a look back at our latest two trades on NVIDIA, one bullish, one bearish, that both worked out, and also give you a look forward to a new trade we'll be coming out with that is more neutral in nature. So let's jump in and take a look. First and foremost, here was the original trade that was from May 14th, as you can see, a bullish put spread trade on NVIDIA, selling a put credit spread. Earnings due May 22nd. Stock pretty much neutral on a technical basis back then. We'll take a look at the chart in a second. 750 level, that seems like eons ago. This was actually pre-split on NVIDIA, held nicely. So our trade idea we came up with was a put credit spread, buy to open the May 24th expiration 735 put, sell to open the May 24th expiration 750 put, bring in about $1 net credit, take advantage of high earnings week, right? And being a willing buyer if the stock dropped 15% to that 750 level. Lo and behold, we fast forward from May 14th when the recommendation came out on Tuesday to Friday the 17th, right? NVIDIA has rallied sharply since it came out on Tuesday, right? Let's grab that gain and close out the spread in front of earnings, right? We squeezed most of the profit out of the trade, right? And we eliminate the remote possibility, but a possibility nonetheless of an earnings torpedo, a big drop in NVIDIA, and free up that margin requirement. So we recommended to cover that trade for a 25-cent net debit. So to quickly wrap things up, our entry was to sell the spread for $1 net credit, cover it for 25 cents, right? Our net gain on the trade was a very nice 75-cent net gain, right? For only a 3-day holding period. So for each spread you did, you were able to make 75 bucks and move on very quickly indeed. Fast forward then to June 11th, for our next trade on NVIDIA, a bonus trade, right? And this was after the 10-for-1 stock split, after earnings and so forth. We saw a big rally in NVIDIA indeed, right? $3 trillion market cap back then, it still is, right? Past Apple as the number 2 in the S&P 500, right? Price to sales over 37 times, right? Understand that NVIDIA is growing greatly, right? But 37 times price to sales is utterly almost beyond belief, right? Approaching the highest multiple ever. And that's despite the fact that interest rates have shot up historically at a fast pace from where they were about 2.5 years ago. We've seen the 10-year yield well under 1.5% to now just under 4.5%. Fed funds rates parked at 0, now over 5%. So valuation multiples should contract. Instead, in the case of NVIDIA, they've expanded. And the technicals, right, which is a little shorter term kind of way to look at things, by far the most overbought in the past year, but finally beginning to weaken. So our trade idea at the time was now a bearish call spread, buying the 129 calls that expired the traditional June 21st, selling the 127 calls, bringing in over 60 cents net credit, a close to 50% return on risk on the trade, which is very nice indeed on this one, right? 45% return rate. So we're, risking less than 120 to make well over 60 bucks. So you can see what happened as far as the price of NVIDIA on the day of the trade. It was trading just under 121. On June 21st, closed just below that 127 strike price, out of the money here, right? So we're able to keep that entire net credit, have the trade expire worthless. So our initial trade going back to May 14th, we were bullish on NVIDIA simply because, we thought the stock was due for a pop here, which indeed did happen. We took the trade off just to eliminate any risk because we had a nice profit on the trade. And then after that big rally higher, right, we took a more bearish viewpoint on NVIDIA, and that trade worked out as well. So taking a look at the chart on NVIDIA, here you can see, here was when we were bullish back in mid-May, right, with the stock trading right around that kind of $90 level. Then on our second trade, our more bearish trade, right, which was, almost a month later in June, and we've seen the stock move from well under 100, right, to now well over 120. We were getting a little bit bearish here. The stock did rally and go against us, but because we had a much tighter spread and received a nice credit on the trade, right? Remember, our initial trade was a 15-point wide spread back here for dollar credit. Here, a 2-point wide spread for over a 60-cent net credit. So even though the fact that the stock did rally up and trade briefly over 140, only to close back down at 130 that day, right? Which absolutely gave us more conviction to hold out on the trade. That's the kind of price action you like to see for a blow-off sort of top, key reversal day, right? And then the following day on Friday, as you can see, the stock did try to open higher, failed yet again, traded down below 125, closed below 27, so that short call spread expired worthless for the full credit. But this was a trade, and the reason that we like doing credit spreads, right, you don't have to really be as worried, right, if the trade goes against you because you have defined risk up front. In this case, our risk was only about 140 bucks, slightly even less than that per trade, so we were able to live with that. And this kind of price action gave us more encouragement, this key reversal blow off top day. And now you can see the stock has absolutely started to peter out sideways here. So we think going forward that NVIDIA will probably continue to languish here, and that kind of 140 area will be a significant top, and then down somewhere around 110, right, which was just below the level where the stock really took off again, right, will be key support here. So that sets up ideally, we believe, for a iron condor trade. In essence, taking our two previous trades, right, a bullish put spread, right, and a bearish call spread, combining together at the same time, selling them simultaneously. In this case, going out to the Julys, which only have 19 days to expiration, plus we have the holiday, which normally is kind of a low volatility, low volume time. So we like going out and selling the 140, 142 call spread, the 110, 108 put spread, bringing in almost 50-cent net credit, right? So risking a little bit more than 150 bucks, right? Because only one of the two spreads has the possibility of getting in trouble, right? And they're 2-point wide, so 2-point less the 48-cent net credit gives you a 152 net risk on the trade. And then your risk return ratio is roughly about 33%, right? Bringing in about 50 bucks, risking 150 bucks to do so, and you only have 19 days to do it. And you have about 15 points cushion on both sides, with NVIDIA closing just below 125. That 110 put strike, 140 call strike give you a very nice cushion indeed of over 10% over basically the next 3 weeks on NVIDIA, with some of that being a holiday week. So that's how we're, looking at NVIDIA going forward. Our kind of money for nothing trade, right, to quote Dire Straits. And then looking back how this kind of strategy worked very nicely on NVIDIA in the past, right, taking a bullish stance here that worked out very quickly in 3 days, and a bearish to neutral stance here, right, which even though it briefly got in trouble on the spread, ended up, because the stock absolutely finally had some semblance of sanity, right, did pull back and close out of the money here. And going forward, I think these two levels at 140 and 110 level now, right, which is kind of that, level where the stock really held going back to this time frame, as you can see here, is probably the area we like to hang our hat, to be bullish around the 110 level, bearish around the 140 level. So until next time, this is Tim Bigham. Here's the good